Are you worried about the next big market crash? Do you ever get that feeling that the game is kind of rigged and you're just one wrong move away from losing a big chunk of your savings? Well, in this explainer, we're going to pull back the curtain on a potential market trap that seems to be getting set for 2026. And we're going to show you exactly why the old rules, the advice everyone gives you, it just might not be enough to protect you this time. It's a pretty scary thought, isn't it? The idea that you could be doing everything right, you're following all the conventional wisdom, and you could still be walking straight into a financial ambush. But that might be exactly what's happening to millions of everyday investors right now. The rules of the game are changing right under our feet, and the biggest risks are kind of hiding in plain sight. If you're not paying really close attention, you could be the one left holding the bag. You think something like this can't happen to your portfolio? Well, think again. I mean, look at this number. This isn't just some abstract figure on a slide. This is what happened to the life savings, the retirement dreams of people who thought they were totally safe investing in AIG, a blue-chip company, a titan of the financial world. This is the brutal reality of what's at stake when these big risks all converge, and it's exactly why understanding the forces at play in this 2026 market trap is so critical. So how do we spot this trap? And more importantly, how do we get around it? It all starts with understanding the battlefield. So in this explainer, we're going to go on a little journey. First, we'll start with the psychological traps that lead investors down the wrong path. Then we'll dissect the two different monsters of risk. After that, we'll pinpoint the specific economic storm clouds that are gathering on the horizon for 2026. And I promise, by the end, you'll have a clear roadmap for how to not just survive, but maybe even thrive in the challenging times ahead. Okay, so the first step in avoiding any trap is to figure out how we get caught in it in the first place. And this brings us right to the investor's dilemma. It's that internal battle between our gut feelings and our cool-headed logic, and how that conflict can lead us to make some pretty disastrous decisions with our money. We've all been there, right? You own a stock and you see the price start to tumble. Your heart starts pounding, your stomach drops, and that little voice in your head is just screaming, "Sell, get out now before it goes to zero," right? That panicked voice is reacting to the price. But what if the company itself is still fundamentally strong? What if its long-term value is still totally intact? See, that's the crucial difference Buffett is talking about here, and learning to separate those two things is the absolute key to surviving any market turbulence. Think of it like this. A consumer walks into a grocery store and grabs a gallon of milk just because it has a bright orange 50% off sticker on it. They don't check the expiration date, they just see the low price. An investor, on the other hand, is like a master chef. They aren't looking for cheap ingredients, they're looking for quality. They inspect the milk, they check the date, they know exactly how it's going to fit into their recipe. See the difference? One is just gambling on a deal, the other is executing a well-thought-out plan. That's the difference between getting caught in the trap and avoiding it. Okay, so we've established how important it is to have a plan to manage risk. But what kinds of risks are we actually talking about here? Well, there are two main types, and the first one is probably the one you're most familiar with. It's the risk of a single company you've invested in suddenly going up in flames. So this is called non-systemic risk. And I want you to imagine your investment portfolio is like a fleet of ships sailing on the ocean. Non-systemic risk is like a pirate attack on a single ship. Yeah, it's a total disaster for that one vessel and its crew, but the rest of your fleet is untouched. They can just keep sailing safely. The problem is isolated. It's contained. But what happens when a Category 5 hurricane appears on the horizon, threatening to sink the entire fleet? Just look at these names. These weren't just companies. They were people's dreams. They represented retirement plans, college funds, family legacies that were built over generations. And for countless investors, they were all wiped out, some of them in the blink of an eye. This is the devastating power of non-systemic risk, and it's a brutal reminder that in the world of investing, no company is too big to fail. So we've seen what happens when one ship in the fleet goes down. But what about that hurricane on the horizon, the storm that's big enough to sink them all? Well, that is the second and far more dangerous type of risk we need to talk about, and it's the one that's lurking at the very heart of the 2026 market trap. This is systemic risk. You ever been at the beach when the tide suddenly rushes out, like way further than usual? It's an amazing sight, isn't it? All the rocks, the shells, the weird sea creatures that were hidden under the waves are suddenly just exposed for everyone to see. Well, that's exactly what systemic risk does to the stock market. It's this powerful, unstoppable force that pulls back the water and reveals who is taking on way too much risk and who built their strategy on solid ground. Remember 2008? That wasn't just a story about banks and balance sheets.
It was a human story, right? About millions of people losing their homes, their jobs, their life savings. It was a systemic crisis born from this perfect storm of cheap money, reckless lending, and a housing bubble that, let's be honest, everyone knew was waiting to pop. It's a terrifying reminder of just how quickly and violently a systemic crisis can spiral out of control and just affect everyone.
You know, they say history doesn't repeat itself, but it often rhymes. And right now, the echoes of 2008 are getting louder. This is why we're focusing so much on 2026. A perfect storm of specific, measurable economic pressures is building, and it's creating a pressure cooker environment that looks eerily similar to the conditions right before the last great financial crisis. All right, catalyst number one. Imagine you have a massive credit card bill that's coming due in a couple of years. Now, if interest rates are low, no big deal. You can just transfer the balance to a new card and keep going. But what if interest rates have skyrocketed? Suddenly, you're facing this colossal bill you can't pay or refinance. That's the exact situation so many corporations are facing with this $1.8 trillion maturity wall of debt that's due right around 2026. It could force a massive cascading sell-off across the entire market. Okay, catalyst number two. For years, crypto was sold as the ultimate escape pod from the traditional financial system. Digital gold, right? Well, it turns out it's not an escape pod at all. It's more like a sidecar that's been bolted onto the same roaring motorcycle. And with a 70% price correlation to the stock market, when that motorcycle hits a patch of oil and crashes, well, the sidecar is going down hard right along with it. Catalyst number three is all about emotion. We've all felt it. That knot in your stomach when you look at your portfolio and it's just bleeding red. That's fear. And when that fear spreads like a virus, it can create a self-fulfilling prophecy of panic selling. The Crypto Fear and Greed Index, it measures this sentiment. And back in February of 2026, it hit a 14, which screams extreme fear. This just shows how fragile confidence really is and how quickly panic in one market can ignite a fire in another. And now for the final catalyst. For years, crypto was the Wild West of finance, right? A place to hide money from the prying eyes of the taxman. Well, the sheriff is finally riding into town. With these new CARF regulations, the party's over. And when all that undeclared money is forced out into the open, it could trigger a tidal wave of selling that swamps not just the crypto market, but the stock market it's so tightly connected to. Okay, so we've seen the storm clouds for 2026 gathering on the horizon. We've got the trillion-dollar debt bomb, the crypto sidecar, that fragile sentiment, the regulatory crackdown. So what can we do to protect ourselves? The traditional answer you'll always hear is diversify. But what if I told you that in the face of a true systemic crisis, diversification is like bringing a knife to a gunfight? Now look, the basic idea behind diversification is totally sound. Think of your investment portfolio like a balanced diet. You wouldn't eat only pizza for every single meal, every single day, right? Of course not. You need a healthy mix of fruits, vegetables, proteins, all that stuff to make sure your body has what it needs to stay strong. And that's the simple idea behind diversification. It's creating a healthy mix of assets to protect your portfolio. But here's the thing. What if you're not just worried about getting the flu? What if you're worried about having a massive heart attack? A flu shot is completely useless for that. In fact, relying on it for heart protection gives you this false sense of security that could literally be fatal. And that's exactly what diversification does in a systemic crisis. It makes you feel safe, right before the entire system collapses around you. This is the bottom line, right here. Imagine you're inside a house that's on fire. Does it really matter if you run from the living room to the bedroom to the kitchen? No, the whole house is going up in flames. That's what a systemic crisis is like. It's a fire that burns through the entire market, and diversification is like trying to put it out with a little squirt gun. It's the right tool for the wrong problem. Okay, are you feeling a little scared yet? Good, because a little bit of fear is a healthy thing. It's what keeps us alert, and it stops us from making reckless decisions. But we are not going to leave you in a state of fear. No way. We're going to show you how to channel that fear into power by taking back control of your financial destiny. It is time to stop hoping and start planning. Stop wishing and start doing. It's time to stop being a passive passenger on this investment roller coaster and start being the pilot in the cockpit. That is the fundamental difference between hope and control. Hope is a wish you just toss out into the void. Control is a flight plan, calculated and set before you ever leave the ground. So what does that flight plan actually look like? It all comes down to answering these 5 critical questions before you invest a single dollar. This is your battle plan. 1. Where is my entry point? 2. Where is my profit target? 3. And this is the most important one for survival, listen up. Where is my exit? The price where you admit you are wrong and you cut your loss, no questions asked. 4. What is my risk? How many actual dollars does that exit represent? And 5. What is my potential reward? This framework is your map and your compass. It shifts you from being a sailor at the mercy of the storm to being the captain who can navigate through it. That is how you avoid the trap. That is how you take back control.